Okay, greetings and welcome to today's educational program, Understanding the Financial Component of Quality by Dr. Gregory H. Watson. This is your moderator, Doug Wood with ASQ's Quality Management Division. So today we have the distinct pleasure of hearing from Dr. Gregory H. Watson. We want to welcome him to our talk tonight. A little bit about Dr. Watson. He has degrees in management, law, and industrial engineering. He's an 18-year ASQ Fellow and past chair of the year 2000. He received ASQ's Distinguished Service Medal, plus the Lancaster, Crosby, and Ishikawa medals. He's been named an honorary member by 17 national quality associations. Dr. Watson delivered speeches to more than 20 ASQ national and divisional conferences, twice for the Quality Management Division. A former quality executive with Hewlett-Packard, Compaq Computer, and Xerox, he has coached executives in quality transformations at Nokia Mobile Phones, Toshiba, ExxonMobil, and over 20 other companies. He is the only Westerner to have been awarded a Deming Medal by the Japanese Union of Scientists and Engineers, the W. Edwards Deming Award for Dissemination and Promotion Overseas in 2009. So it is my pleasure to introduce Dr. Gregory H. Watson. So Greg, the floor is yours.
Thank you very much, Doug. So tonight we're going to talk about quality, and we're going to talk about costs, and very minor accent on quality costs. Most people in quality think that the cost of quality, cost of poor quality, or quality cost is what we focus on. And we're going to do something a little different tonight. And so what I want to do is we're going to think very broadly about how we go through with these things. I want to set the stage for the discussion. So when we talk about this, there are really three aspects in terms of monetary methods that we need to consider. So the first question is, what's the job of accounting? So it almost says it. Accounting counts the money that comes in, that's sales, and also counts the money that goes out as expenses. And what's left between the two, that's called gross profit. Second question is, what's the job of finance? Well, finance decides where we're going to get the money from, and then how do we manage that money that we receive, and then what arrangements do we make to make sure we pay it back to investors or banks? And then the third question is, what's the job of economics? So economics defines the monetary system of society, and it governs the financial linkages between companies and the national system for wealth distribution and allocation of social benefits. And so these are the three components of monetary thinking that actually affect a corporation. And when we start thinking about this, I want to go through, first of all, in the first part here, history of the development of these financial methods in terms of how they affect us. And so economics has often been called the dismal science. I remember a quotation from, I think it was President Truman, who said, you know, what the world needs is a good one-handed economist. And he says, too many economists are saying, well, the economy could do this thing on one hand, but on the other hand, it could do this. And I think that's about how many people think about what's happening there. But let's get a little clear in terms of what's happening. So microeconomics concerns things that the economists are specifically wrong about. Macroeconomics concerns things economists are wrong about generally. Another way of saying that is, to be more technical, microeconomics is about the money you don't have, and macroeconomics is about the money that governments are out of, and just because they spent it all. So this is sort of a comedian beginning point, and so often when I think of what's in my wallet, I need to have a little sense of humor when I start thinking about this. So the roots of economic thinking. So where did this current state of that we talk about economics come from? Well, it's the study of how available resources are used and organized to deal with the needs of society. And when we start thinking about this, it came out of mercantilism and trade. And when you start thinking about this, I just saw a note that I lost the audio. Do you still hear me?
Your audio is coming through fine, Greg.
Okay, I just saw somebody note it. Okay, so discussions leading to mercantilism and trade. The earliest form of economics described how trade occurs between states, and it gave rise to the mercantile class. We're sending goods from our state to your state. We have copper, you have silk. How do we make a deal? And then this eventually evolved into what we call classical economics. So classical economic theory refers to wealth as the ebb and flow of what's happening. And it's about how you assign value for that trade. So there's basically three principles there. So each person pursues what is best for themselves. In other words, we follow our own self-interest. Another is the idea of division of labor. I'm going to do this, you're going to do that, and we figure out between us what is the value. And then there's also this idea of the freedom of production and trade. I can make what I want to and trade with who I want to. And this idea of trade is mutually beneficial. And that together this assures that all the needs of society are fulfilled. And that means not everybody can choose to be exactly one thing. We can't all be lawyers and we can't all be doctors or whatever. We have to have some division of this. So the ability to trade and access to markets are really the entry level conditions for establishing wealth. And if we see in some very poor countries, they don't have this. They don't have access to markets. They don't have the ability to trade. They don't make anything the rest of the world wants. So part of what needs to happen in those countries is they have to find out what can they produce that there's a demand for. Now, when we start talking about applications of economic analysis, we start thinking that people think of economics basically as a mathematical type of science. It's about modeling how things are operating. And so how did our thinking actually evolve? Well, it began with Aristotle, then it was sort of perfected with St. Thomas Aquinas, and then Albertus Magnus. And what these people did was they established what's called the natural law about utilitarian theory, competition. And this is the rules by which we establish prices. It's an interdependence between our beliefs, the metaphysics we think about, what I hold dear, and economics that sets the basis for this free market. So I believe this is a certain value. It's value to me. It's my utilitarian theory. It's worth this to me because I need it. And if I have a bigger need for it, then it's even worth more. Next came Adam Smith and The Wealth of Nations, famously written in 1776, which is one reason why I can still remember when the book was written. So it identified the morality of wealth and established the current concept of what we call the free market. And here we see the invisible hand moving mysteriously, responding to the supply and demand and setting the prices. And what this says is that the market will do this best in a laissez-faire or hands-off condition. In other words, no government intervention. So there's no government policy telling you what you do in the market, but let the free market figure it out. And then we start thinking about what happened in the Industrial Revolution, because that was happening about another half a century or so after Adam Smith wrote this. And we start seeing that mass production actually changed the balance of power in business, because no longer was labor just doing a discrete product end to end as a classical craftsman would, but now they're just a part of a process or a sequence in the process. And it changed the whole economic system. And so then the question comes up, is there some moral imperative for equity in the distribution of society's wealth? If everybody's working in a company and they're only doing a part of that job, how do you actually divide up the value you get for the product that's then sold into the market? And that's what we start getting into in price theory and distribution functions. So we start seeing that this field of economics is sort of divided up. We see macroeconomics. This is the study of wealth in society. So this is talking about how employment, wages, prices influence the whole system's growth. So it's studying balance of trade between nations, the productivity in nations, the relative contributions of the different industries to what's called gross national product, or gross domestic product is a more popular name for it now. And it deals with the aggregate performance of a national economy. Are we getting better? Are we getting worse, particularly relative to other nations? And that's how we understand the competitiveness or relative competitiveness of nations. On the other hand, microeconomics is study the resources in a firm. It's what's happening inside a company. So we ask here then, what decisions do individuals and companies make about distribution of resources, and how does that affect the price of their goods and service? So here we're talking about supply and demand. What do we buy from suppliers? How do we get it into distribution and market? And we have to then figure out, how do we establish the pricing to manage the market demand? So if customers are asking for this much, how do we set our price based on what we can produce? And so this is dealing with local economic condition of the firm within its industry. So microeconomics is what makes a firm competitive. Macroeconomics describes how well a firm's industry operates in society. So we start seeing there's an overlap here, and there's a different role that we have to think about in terms of both of those. And we start thinking about this in terms of accounting. We start thinking we have to account for accounting. That's a pretty bad pun. But we start saying, so accounting is measurement, processing, communicating of financial information about an economic entity. So if we have a company, we say, let's take a look at how much money is coming in. Let's take a look at where it's coming, how do we pay it, and so forth, the terms and conditions of payments. So accounting is, they say, it speaks the language of business. And it's used to keep score. How much did we actually make? And how much can we tell the shareholders are coming back to them? So it's a systematic reporting process. It's reporting and analyzing the transactions of an organization. So we're summarizing the bookkeeping. Bookkeeping is just keeping the records, putting them in a book, and then we're analyzing them, and then we verify the reports that we have an honest reporting of this to the shareholders, and that's what accounting is doing. Now, when we start asking ourselves, well, accounting didn't just happen, it sort of grew up out of things. Where did it come from? So the initial focus of accounting was on, well, how do we pay these workers and how do we make them efficient? So no longer is the craftsman making a deal for what he is selling. It's now that there's somebody in this role of a salesman doing this on behalf of everybody else. So the first beginnings of this were two gentlemen, Emil Gartke and John Menger Fells, and they wrote the very first textbook on cost accounting. And it applied cost records to what's called double entry bookkeeping, which is talking about one side is the receivables and the other side is payables, income and outgo. And they separated the ideas of fixed and variable costs. So fixed costs are what you have to pay no matter what you're producing. Variable costs change because I need more material because I'm producing more material. And so this was in 1887 in their book, Factory Accounts, Their Principles and Practices. Frederick Taylor came along, and before he wrote Principles of Scientific Management, he was actually looking at cost information systems and what is the best way to run a shop, a job shop. And so he created what was called the piece rate system. This is where you pay each worker for each piece of outcome that they produce. So when I had my very first job, for instance, I was making $1.25 an hour, but that meant I had to make so many pieces per hour. And if I made less, they docked my pay. If I made more, I didn't get any more money. So you just make what you're told to make. That's piece rate system. Then he wrote, how do you manage that with shop management? And then finally, he put together his third book, Principles of Scientific Management. And this was about how do you maximize the prosperity of the whole system. But he wasn't exactly so fair about how we shared the money. Then along came Harrington Emerson. He's not so widely known, but he wrote a couple of books, Efficiency as a Basis for Operations and Wages. And so he said the primary idea of cost accounting is to reduce costs by figuring out where are there inefficiencies in the way that a firm operates. And then he went on further, he identified the 12 principles of efficiency. And if you actually look at those 12 principles, that was the early echo of what we call total quality control. And he had done his work also at General Electric. And so some of that migrated into Dr. Feigenbaum's work. And he used costing methods to track efficiency improvement. And so what we started seeing is that what we get is we're going to deliver maximum prosperity through this productive system, but it's not all equitably distributed. There are some very interesting passages in Taylor's Principles of Scientific Management, where he talks about Schultz as being a first-class man. He's very strong like an ox, but he's dumb. And so he'll give you a first-class work because he'll keep working physically all day long. But we can't give him too much money because he'll get, inebriated, and then he'll be dissipated, and then he can't do his first-class day's work. So we're only going to give him a part of that extra money we get out of his productivity. He'll have a better life, and the rest of it goes to management or the corporation. So how did modern accounting evolve? Well, it started coming in. We started seeing that this idea, the initial thing was, how do we pay the workers and make them efficient? So next came along Alexander Church, and he talked about accounting based on scientific management to assure production of parts efficiently and profitability. and it used a documented structured accounting system. So this was the proper distribution of expense burden in 1908, production factors in cost accounting and works management in 1910, and then in 1914, the science and practice of management. He wasn't so strong as the next guy. You might have all heard of him, Henry Gantt, and he invented a chart to assign responsibility to measure performance, not just maintain cost control. And that was organizing for work, and of course, that's the Gantt chart, which we famously use for lots of project management things. He actually worked for Frederick Taylor, and so he was one of Taylor's engineers. And then we have along coming G. Charter Harrison, who developed the equations to calculate standard costing. And he published them back in 1921. And we have to remember, he was actually an industrial engineer. And he was talking about cost accounting to aid production, a practical study of cost in accounting. And so the basic elements of standard costing have now been developed with these gentlemen coming into play. And then we start seeing, we have modern accounting. And so the next thing we start seeing is analysis methods. And so another familiar name, James O. McKinsey, who created the McKinsey Consulting Company. And he invented an ability to analyze finances and provide managers with decision-making support. So this isn't just what the engineers did about how do you improve efficiency of a bricklayer. It's about how do you manage the whole factory. And it's at an engineering study. So his two books were Budgetary Control, and that's now the job of a controller in a company, and Managerial Accounting. And so managerial accounting is the reporting side of accounting. It's how do we make more money out of the things we do. And basically those are the two lines of business that the McKinsey Consulting Company still holds today. Next came sort of the unsung hero, F. Donaldson Brown. He's not really known very well, but he created ratio analysis, which is the analysis of what he called the financial efficiencies. So these are return on investment, return on equity, return on capital employed, debt equity ratio, and so forth. And this is how you manage budgets, he said. And this happened actually because he was working for Pierre DuPont, and Pierre DuPont was named the president of General Motors. Well, we have to go back and look at to get the full story. You know, after World War I, General Motors was having some financial difficulties. They couldn't quite recover, and they needed cash. DuPont had a lot of cash because they had made explosives for the war effort. And so the DuPont family sent their son Pierre to General Motors with the money to help bail it out. And then he brought along F. Donaldson Brown to keep track of the money. But true to form, management prevails, and it's called the DuPont method rather than the F. Donaldson Brown. And everybody's forgotten F. Donaldson Brown. That's why his name is in bold blue. And finally, we have our good friend Walter Schuhart coming along. And he concentrated on production efficiency for economic control by saying, let's control the process of production using statistical methods so we get predictable results at the lowest total cost, including the cost of failure. And so his book was called The Economic Control of Quality of Manufactured Products. I don't know if you've read his book, but actually I believe it's only 2 pages that actually deal with economic control. And one thing I found out when I was doing some of my research was the reason it was called economic control was his boss had an objective to figure out how do we do the economic control of manufacturing. And by putting economic control into the title of this book, he got his bonus for that year. So what we start seeing is now financial and operations methods had both different measures of variance. So variance, in a statistical sense, had been defined much earlier. And here we see this coming out of Sir Ronald Almer Fisher, who created the F-test for the Fisher test, DOE, ANOVA. And he talked about that being the mean squared difference from the mean, which is a statistical definition of variance. The accounting definition of variance came in the mid-30s. And in the mid-1930s, their idea of variance was the difference between the plan and the actual. So we see 2 different now operation and accounting side using the same word in 2 very different ways. And it's no wonder we get a little confused when we try to talk to each other. So what we start seeing is that it's very clear that the performance of money must be measured. And we've created lots of systems, lots of language around this. And for many of us, if we haven't been brought up in this financial world, it sort of looks a little funny. It's just like if I start speaking to you in Russian, or I start speaking to you in Chinese or French or Spanish, and you start saying, what the heck is he saying? Well, that's actually, I think, what I felt the first time I had an accountant try and tell me what was going on. And what we start seeing when we look at accounting is that accounting actually is, in a financial enterprise, any business, it has certain elements. It's got tax accounting, and that's to make sure that we pay the government what we're supposed to pay the government, or as little as possible. We have financial accounting, which then takes cost of the cost accounting system. So we look at what's the cost of goods sold, how do we value inventory, and this is how we manage our own costs. And then we have managerial accounting, and there we measure costs, and in the middle we see this performance evaluation and analysis. So here we're taking a look at the plans we had, how well did we do. So this is about reporting profitability and analyzing processes to find out where's their cost or waste, and it's learning about what sort of financial corrective actions we need to make processes more monetarily efficient. On the other side of this dotted line is planning and decision support. And this is the type of things that are happening in managerial accounting where we're trying to say, how do we actually make sure we have money for the future? You know, how if we have capital equipment, then it gets old over time, we depreciate it. What is depreciation? It's the money you're actually setting aside to be able to reinvest in replacing that capital equipment when it becomes worn. And so we see somebody has to do that type of planning. And that's the predictive side rather than historical. Most people think of accounting, they think of, oh, we have to close the records at the end of each month and see how well we did, what was the final score we had for that month. But we also have this predictive side, and that's where it starts getting interesting. So in here, I've got a whole group of definitions. So managerial accounting is where we identify, measure, analyze, interpret, and communicate the information about this. Fixed costs, they don't change no matter what's happening in the period. Variable costs, it's material, labor, overhead that does change as we're changing production. Standard cost is what we assign, if you will, as the average cost of producing a particular product. Overhead is the basically the cost that we have or expense that it doesn't go to any particular function, but we need to then distribute it. And so that's why we call it overhead. So something like rent or utilities or the manufacturing manager's salary. Those are overhead types of functions. Absorption is the process where we assign fixed or variable costs to particular products when we're trying to figure out how we are costing them. So we say we have to absorb costs. We cannot directly relate to the cost of making that product. And this is actually, I call this lying, because what we're really doing is saying, okay, part of your salary goes into that product. It doesn't matter that you didn't have anything to do with it. We just have to account for how we pay you somehow. And then finally, we have ratio analysis, which is this DuPont method. And this is how do we convert this financial data into some way that we can make comparisons. So money versus investment, money return versus the assets or the capital employed, and so forth. And all of those are different ways we do comparisons for talking about the profitability of a company. Now, we start seeing that the CFO is very important to the executive because they're the ones who actually are keeping the report cards. They're giving the reports to the governing body, so the shareholders, if you will, the stockholders, the board of directors, and they're reporting about what was coming in, what was going out, and what sort of benefits do we actually produce from this economic entity we call a company. And so the accounting systems were actually developed in the 1930s to do two things. One was to account for taxes. In America, one of the reasons all those things happened in the 1930s was that was when corporate income tax was first levied on corporations to pay for getting out of the Great Depression, and then again to pay for the Second World War. And so that was one function. The other function is to report to the shareholders how much money is getting made. So we're managing and controlling legal financial transactions for management, and we're also trying to make better decisions about actions to deliver future results. So when you take a look at the price that a share is selling for in the market, there's some component that's based on history, but there's another part of that is based on the future expectations or the promise that will be fulfilled in the future. So you're sort of playing a little risk game of, will they have another hot product or a hot application, a killer app or something like this. And so the thing that is important, though, is the CFO and their job, they report to the board. Okay, yeah, they look like they're reporting to the CEO, but they're actually reporting to the board of directors. They're one of the few people in the company who are actually required to report to the board independent of the CEO about the financial performance of the company. And so that's a very important thing because this CFO is actually giving the report on his boss, and he goes there, and the CEO can't do anything about it. So how does financial accounting actually work? Well, what we want to do is demythologize this top tier of what's happening. And so executives are managing bottom line, and that means we're cutting costs. When we're starting about top line, we're talking about increasing sales, increasing growth. And that's the difference between bottom line and top line. Managing organization finances means that we have to learn this language and the logical system it uses for accounting. Okay, so organization efficiency is actually cost control, and it's modeled using this cash flow of incomes and expenses. When does money come in? When does it go out? And what we have left is what's called working capital, or the money we can use to pay our current debts and expenses. So we have to learn how the changes in this flow actually influence an organization's profitability. And so an example of how this system works will help. So I'm going to go through a couple of slides now. We're going to talk about how do we interpret this business system of accounts. So this is a hypothetical company. So they have sales. We're going to say $100. Cost of sales is $75. That means they have a gross margin of 25. So that's what they outcome versus what they expended. So that's gross profit, if you will. But then they had this overhead, selling, R&D, and general administrative expenses, say $14. So that means there's $11 in operating profit. Now that doesn't mean they still have to pay taxes. They still have to pay interest. So some people call this EBIT. And so if we increase by 10% the sales, we can see how that trickles down, and instead of $11, it goes directly to the bottom line. And so we see that the profit went from 11 to 21, and that's a 91% increase. So let's just increase our prices 10% and we'll be better. Well, unfortunately, supply and demand doesn't work that way. And so the customers then want to go someplace else if there's an alternative and other options where they can go. So let's take a look at the other side. This is the one that most management systems are working on. So we see the same base case, and what we see here is now we're going to reduce cost of goods sold. So here we're taking money out of the process because we're getting process efficiency. We're taking it out of the cost, whether it's the purchase goods, raw material, or transportation costs. And so as we do this, it trickles down and the administrative cost stays the same. And so we've gone from $11 to $18.50, or 68% improvement. So that's still pretty good improvement. And so this is why the majority of companies keep saying, we have to reduce cost of goods sold and operating costs and so forth. Now, the third thing is that what happens if we can't move the sales? We've already taken all the money that we can out of cost of goods sold. And what happens if we can reduce this idea of the R&D and admin expenses? And we can do that 10%. So what we've done is we've moved from 11 to 12 and $12.40. So that's a 13% improvement. But this is, it's only a total of 14% that we're taking the 10% on. And what is this money? Well, this is your advertising budget. It's your R&D budget. It's the overtime of people. It's how you manage the salaries of people when they're on vacation or not on vacation. It's, do we give them extra benefits? Do we give profit or bonus and so forth? All of that money comes out of here. And what we start seeing is that's what many people do, because this is where management feels they have the most control or direct control over discretionary spending, or spending they think is discretionary. And now if we see what happens is If we move this whole thing, do it all together, we've made 272%. So we've got the magic silver bullet now. So obviously we can't do that. But this gives you sort of in a humorous way, that's how the system is designed to work. And so what do we want to be able to do in this? Well, in the words of some executives, these are direct quotes from executives that I've worked with. And I say, one said, I find that at times our accounting methods either work against our improvement activities or mislead our focus. Well, that's not a good thing. Another one said, it's only a 1% problem, so we can ignore it as it will cost more to correct that in the process than we pay in warranty costs. And that was actually a saying I heard very much in the beginning in the 1980s. Came out of the words of a manager, and I heard it again in the mid-2000s, and I heard it again about 5 years ago. And there's a misconception. We're going to come back to that misconception a little bit. Because we don't have to worry about the bad parts coming back from our suppliers. We'll just charge them as restitution for poor contract performance. Well, there are many companies that have processes you call reparation processes. And reparation process is saying we will get the money back from the supplier if we got bad parts. But you never get anything more because it's capped at the cost of the parts you bought. So unless they've done something much more serious where they're liable for something more because there was gross negligence or illegal action, that's the limit of their liability. That's called strict liability law. And so we start seeing that's another thing. Here's another one. It doesn't matter if we're either a little above or behind estimates. It all averages out in the end. Well, that's a very big assumption behind that it's all a normal distribution. And we start finding out is that productivity is not normally distributed. So if we're averaging 93% and all of a sudden we have a 0% day, the average of that doesn't come out to be where we really want to be. And so we have to work things out. So I say, really? Are you serious? And what this is showing is that many managers themselves do not understand how these systems really work. And we start seeing there's some financial decisions or implications of executive decisions. So traditionally, we see that the traditional idea is act quickly, show fast financial returns and benefits, and make it easier for management to rapidly implement. So I wrote a paper in the Journal of Quality and Participation. It appeared in this last January's issue. And it talked about how profane knowledge seeks easy answers. And if you take a look at this, it's sort of tongue-in-cheek, but I talked about speed of implementation, difficulty to manage. So if you take a look in this fast, 1 year or less, and easier, you see have a sales campaign. That means change pricing, discontinue products, change incentives, reduce budgets, replace management, downsize organizations, close facilities, squeeze suppliers on pricing or discount, increase, reduce debt. Many of you find, well, that's what our company's doing. Yeah, because that's the tendency of management to go there. There's some things that are more difficult, but it takes a little time, and maybe we have to take more things to arrange. So management tends to move up there. You go to the bottom right, slow, over 3 years, more difficult. Develop a new market, introduce advanced technology, change your work culture, design an innovative business model. Those are the things that far-sighted management looks at. And so we start seeing that what is happening is financial reports drive all decisions to that easy box for that short-term implementation because they've got to be able to deliver every quarter what that estimated profit is. And so this is driving management to those easy choices. So we want to have a scientific approach to studying quality. And so Matsubashi, I've mentioned him before, he says, do not seek to follow in the footsteps of the old masters. Seek instead what those masters sought. So what were the masters seeking? They were seeking delivery of profitability that would provide maximum economic benefit. So let's then talk about this financial treatment of quality for a while. So how does quality relate to economics and finance? So macroeconomics is providing for needs and distributing wealth. So this is tax and monetary policy. So here we look at gross domestic product per capita. In microeconomics, we try to increase sales, reduce costs. And we do this with capital investments. So this is the emphasis on productivity, and profitability. And this should sound very familiar to all quality folks because that's where the world we tend to live. And both of those should have an impact on quality of life. On the macroeconomic side, it's providing for the system support from society. On the microeconomic side, it's for providing the benefits that come from the firm. So when we start counting these things, we start counting now for cost of poor quality, reject, scrap, rework, we start seeing there's some weaknesses in standard cost accounting. And because of this, management really can't get clear about what should they improve. So cost accounting measures the cost of doing. So we made this wrong. It doesn't manage the cost of not doing. What's the cost of I didn't buy that on time? Well, we don't cost that out. There's nothing place book in the record say delay in purchasing, and so we start seeing this. And Peter Drucker said it's these failures of omission that are not in the accounting system that actually probably drive more real waste in the company. So standard cost accounting does not count for our opportunity cost. We spent the money here, but now we don't have it to spend on this, and we really need to, but we don't have that. So we lose some benefits as benefits foregone when we have decisions that made to pursue one particular commitment of those resources, and now we don't have anything left. This is an interesting question that just came up in today in the finances. We have one state that's having a big problem in terms of their wind losses that they had. They said, government said we need $4 billion to bring this back. They get $4 billion. But that's coming out of the same money, the same pocket that the government's trying to pay weekly unemployment. And so you start saying, well, wait a minute, if I spend on one, I don't have it to spend on the other. That's opportunity costs. So this is opportunity costs is the benefit would have been derived if the resource decision was made differently. And standard cost accounting then assigns cost to specific cost center. And even if it's easy to assign them, it's not possible to link all of those things together. And so we have these informal rules we use to balance the books, and that's the process of allocation. If I don't know where to put the money because I can't really trace it directly to a particular area, then I allocate it or lie. I say it's there. And so what that does is all of this distorts where is money actually spent. And therefore, management makes summary decisions. They don't actually see exactly what needs to be done to improve the firm. So business analysts have to investigate and find out what are all those opportunities for improvement. So it's easy to count what you can see, but it's difficult to count what you can't. As Einstein said, not everything that is counted counts, and not everything that counts is counted. So here we see standard cost is just the tip of the iceberg. These are the things we can easily find out. Rework, scrap, sorting, maintenance, warranty claims, material write-offs or obsolescence, excess labor hours. What we can't see are all of these things underneath, and these either affect costs in our supply chain or costs that we don't really have as part of our accounting records. So we start seeing averages and summary data are distorting, so management can't really understand what's really wrong in a company. So we start seeing, we talk about quality costs, and what we tend to talk about this cost of quality being failure cost, appraisal, and prevention costs. So we start seeing that these are direct, indirect rates, costs of quality, and we start saying, okay, well, this failure cost, for instance, this is obvious. We want to minimize that. We don't want to have failures and delays and delinquencies. So visible failure costs are easy to detect. It's tangible. But it's difficult to understand where this occurs in the whole causal chain, going all the way back to the customers or suppliers. We see appraisal costs and prevention costs. So appraisal costs, it's testing and checking. And we see that's also what we would call a waste. And prevention costs is what we do to keep the other two costs low. And so we want to minimize appraisal costs, control the prevention costs, and only prevention costs are really worthwhile having in our budget. We have to be very careful. We don't want to budget that we're going to be having a 7% cost of poor quality in the future. But if we have if we don't have a zero-based budget, if we start budgeting based on what we spent last year, we are actually budgeting for next year to have the same amount of failure. So we have to take that money out of the system. And what's actually happening is that standard cost is this value that we have on average. But if the process was 100% effective, there's a loss between that 100% effective and where we actually were. That's the same as the difference between CP and CPK. So if you want to think about it, CP is the ideal process running where everything is efficient. CPK is the value of the process performance at standard cost. And we could start seeing that there's lots of reasons why we have these losses in the process. So Shingo said, the most difficult kind of waste is the waste you do not recognize. So we have to get very clear, where is that waste coming from? And this type of waterfall chart where we can actually see that is one way of being able to present that loss situation. We also have to think about external costs. So waste can come from internally from things we do, or it can come from customer economics, the impact we have on customers and their productivity or their ability to use our products and services. It can also come from the supply chain in terms of waste that are built into our parts or built into the system that we use that we paid for. And so we see often the external costs associated with poor quality are even greater than the internal costs. And so we have to be sure we really understand what is the true impact of this on society. And we start seeing this is a new way of thinking about costs in a total sense. So what's the best reason to do a one-time cost of quality survey? It's an eye-opener. So it's a wake-up call to management. They finally get to see it's that bad. I recommend never, never, never put in place a cost of quality tracking system because it's not adding value, because you're dealing with the allocated systems. The only way to manage costs in a company is through an activity-based costing system. I put these in place at Compaq. We had it in place at Hewlett-Packard, Xerox. And the reason is because you need to understand where are costs coming from, not where am I assigning costs. Where costs are coming from is a function of what the process does. And that we can fix. And so let's talk about then this last component here. And I want to talk about financial decisions about quality and what I call under quality and over quality. Now, you've probably seen these charts before, where we start seeing this defect rate going down and the cost of control going up. And the good economist says right in the middle, we have the point of diminishing economics returns. And it just so happens that occurs right at about a 1% failure rate. And that's why people say, the failure rate is 1%. It's going to cost more if we keep reducing it, because they remember this graph. What's actually happening under quality over on this left-hand side is cheating the customers because we're actually shipping bad stuff to them. Over quality is cheating the shareholders because theoretically we're spending more. So the idea is you can have too much quality for the cost you've invested. So where did that model come from, and what does it really show? Is that trade-off legitimate? Well, we start looking at this, and the model showed up in the mid-1950s, where control occurred through inspection. So elimination of defects occurred because we added more inspectors. One time, the Hawthorne Works in just outside of Chicago, the very first job that Joe Duran had was working at the Hawthorne Works. And the comment that he made was that there were 60,000 workers in the plant and 13,000 of them were inspectors. Well, that's an awful lot of inspectors. That's all overhead function. That is cost of quality. And so their job is to sort out and find good products to send to customers and get rid of the unacceptable ones or the defectives. So the defect rate is what happens when you add another inspector. So you have less escapes going to the customers, but you've got then the expense or the cost of control is the additional budget of the salary and the overhead function of that inspector. So that's a very expensive solution. So today we're not allowed to hire lots of inspectors in companies unless we really have a crisis. And so we start saying, can we really do this? Well, this whole strategy is not viable. We have to do something different. So we start talking about this under quality condition. We see this occurs if investments in profits or products or services do not deliver the expected level of quality as desired by the customers. So it's this left-hand side, the customers are losing. This is the natural state of performance. Losses or defects or waste occur and they don't produce value or efficiency is lost. So under quality actually occurs if the features do not deliver a level of performance that we promise to the customers. So standard cost is actually including this cost of poor quality in the base. So this is the constant battle we fight in the operational processes to get operational excellence. Can we actually get these randomness out of costs out of the system? Over quality, on the other hand, occurs if investments are made to deliver quality that customers don't want, or delivering products or services that they won't buy. And my favorite thing of thinking about this is the mobile phone. I look at all the functions in there, and I wish I could get rid of 2/3 of them. I don't want them, but I'm paying for them. And when I bought the phone, somebody had to pay them to get them in that phone, and I'm the one with the money, so I'm paying for them. Sometimes they'll update. I'm not using them, but I have to pay for the minutes of airtime that it takes to download the system. And then I'm also paying in terms of my getting upset and losing time because it's taking time away. I can't use the phone while the download's happening, and so forth. So the idea is also that sometimes we have this over quality if we're investing in things that are not as productive as they should be. So if I'm buying unproductive equipment instead of fixing the process. So over quality is something we should address in the design of the production process and how we deliver goods. So it is attacked through design excellence. And as we start taking a look at this, we start seeing that if we actually are doing this right, we're actually reducing all of the costs. So this cost of control, if we look at it this way, as we're going down, I'm just using sigma values here as a way of estimating. I don't use sigma actually in any real calculations because it's a good measure. But we start coming down here and we start seeing, okay, as we're going down, we're actually dropping the cost. When you start taking a look is, where is the cost increasing? And it's not. So step one is get the design right according to market strategy. Step two, design and develop cost-effective system of production. And step three is operate that end-to-end production system with efficiency. So accounting for transaction costs by using a form of activity-based costing is really the best way to see where costs are incurred and how to eliminate these things. So there's a rough heuristic that we see about this system. And when we talk about defects, we say we have 5 to 7% defects, but that actually translates into about 20 to 40% of cost of poor quality. And the reason is because that 93 to 95% good is all following a process that has been actually established. On the other hand, that 7 to 5% that's bad, it's all now following expedited activities. It's off the books. And we're all doing special things. We're sending people there. We're spending more money. We're buying extra parts, testing things, and so forth. And this is why cost of goods goes up so much with small, if you're relatively small defect levels. So the idea of this goalpost mentality is no longer being held, where we have just above spec and over spec, and between these spec levels, everything's fine. What we start seeing is that this idea of the Taguchi loss function, where we start seeing that he says there's 3 rules. So if the target is bigger than better, I should maximize performance. That's productivity and revenue. If the idea is smaller is better, then I want to minimize my target. And that is like cycle time, safety defects, costs. I want to minimize all this. If nominal control is best, I want on-time delivery. I want on-specification engineering characteristics. So we see quality should be designed so it minimizes the loss to society after the production occurs. And we start looking in new product development. We start seeing there's a whole lots of change. I don't have time to talk about these, but this is about the Toyota system on how it does what's called design costing. And so this is how they go through target costing process based on allowable cost and perception of value. That's the utility function I mentioned in economics. So that's the target costing process. We see here is break-even time of Hewlett-Packard. And this is about the early investment. So that red line is we're investing money in product development. The vertical line is now we launch it and we start getting a payback period. And when the payback period on a discounted cash flow, we won't get into that, but when it crosses this line, we call that break-even time. So break-even time means we got paid back, and now everything after that is when profit actually happens. And that's what we're talking about, value-added benefits. If we're talking about pricing tolerance, we talk about we have this customer requirements, a lower limit, and then the technical design upper limit. And then we have market pricing. There's an upper limit on what the market will not tolerate, and the bottom limit there is the production cost impact. So there's a sweet spot, and that's where we can have freedom in terms of negotiating price points. And so what we start seeing is, as we look at all of these things, just to close up, the final lesson in all of this is we have to manage costs at the source, because they're incurred in lags in the timing, material leaks that happen, frictions that happens between decision-making processes. This creates waste that leads to the loss in the work processes. So you have to take care as you transfer from the operational scale of measurement, like defects, to the financial. It's not an honest, open, and transparent transformation. And so we start seeing three things. First of all, we address one thing. Understand how costs have been treated historically, where they come from, what the history tells us. We also learned a little bit how quality costs are treated in decision-making, and we could only just touch on that subject. And then finally, we discovered these distinctions between over-quality and under-quality conditions. So with that, I'm just going to say thank you. I'm not sure what the timing is, but Doug, do we have time for some questions, I think?
Certainly we do. I think we've been here this time, and it's certainly worth doing some questions. I have a couple really good ones, and there's probably more that are going to come in. So starting from the earlier one, there was a question about, is there a relation between economics of scale and quality?
Well, this goes back to EOQ, or economic order quantity, which is an old concept. And basically, I have a rule of thumb. Anytime you rely on averages to make a decision, the decision's wrong. And so EOQ is based on average performance. It's just like many people have heard of Little's Law. And Little's Law is talking also about using averages to figure out cycle time. It's wrong. So what both of them do is they are optimistic estimators of performance. You're actually worse than either one. So if you really want to understand the relationship between quantity and cost, you have to understand how well can a process operate consistently. How well can we get, because at certain points in time, processes will break down. For 5 years, I worked at Nokia Mobile Phones. In that period of time, we increased the production of mobile phones from 100,000 a year to over 200 million a year in 5 years. And I can tell you for sure that in that experience, I knew the one thing for sure is in the next 6 to 8 months, we have to change everything we do, because what we did last year is certainly not going to work. And so this is why, in my experience, it's a dynamic function. There's some new thinking coming out of UC Berkeley by Professor David Teese, who talks about the dynamic capabilities of the firm and the need to rapidly innovate in these sort of rapid startup conditions where you're talking about this economic order quantity and how you're moving things forward. And I think it's a really big challenge, but anything based on averages, I would run away from.
Okay. Can you back up to the takeaways slide a minute?
Yeah.
Okay. We had another question here. Could you comment about good financial or cost indicators in total quality management?
Well, yes and no. Now, I think that the ones that I like to use are like the ones in design, getting ahead of yourself. But again, as you get ahead of yourself to start your cost thing, you've got to actually do that at a very fine level of detail to understand what's happening. And just like the break-even time, it's kind of a macro level thing. So if you want to understand, is that a good decision rule? Well, I can tell you right now, break-even time was a measure that was used in Nokia in 2002, not to launch the phone that would have been the iPhone a year ahead of Apple. And the reason was the very first product out there was not going to ever break even. So the new CEO, who'd been a finance guy, said, we're not going to break even, we're not going to launch the product. In Silicon Valley, you know, you're never going to break even on the first of kind of a product, but if you rapidly turn it around and correct your processes, correct the technologies, adjust the design, you make money in the second and then really make money in the third. And it's just a total different business strategy. So what I would say is that most current business strategies about how to perform in a marketplace, it's no longer just about pure finances. It's about the responsiveness, the agility of the company. And if you get down to counting cost to quality, you're in big, big trouble.
Okay, good. And I wish we had time for more, but we have one more question here. John asks, can opportunity costs be considered to be risks or uncertainty compared to certain injury as a benefit? Is trying to say people do not generally handle negative risks, negative costs, or negative benefits well. So how can you use opportunity costs to gain support for a direction?
Well, opportunity costs come out of an interesting place in engineering economics, their origins. And the basic rule in engineering economics is you do not consider opportunity costs. So opportunity costs are the costs you forego when you make one decision. So you have to make the decision itself based on what's called bounded rationality. So bounded rationality means you have to consider the data you have. Are you your competence to make that, and then how urgent do you have to make that decision? If you have to make a very urgent decision, we're going to spend money on this. Do we spend money there or not? No, you're going to be using your gut. If you have time to figure things out, you can actually take a look at some information and understand it. But opportunity costs, I think relating it to risk is absolutely correct. I think when we get better risk-based management systems, which we do not have at the moment, I think that's a good thing to start thinking about. But then you have to get into what's called scenario planning. So in scenario analysis, what you're doing is you're looking at all the potential pathways forward, and you're doing Bayesian statistics, conditional probability theory, about what will all of those costs be on the different paths. And at that point in time, the concept of opportunity cost, you haven't foregone the benefits yet, so it's not really opportunity cost, but the concept of the differential investment return is really the difference in future qualities. And this is a project I'm working on in economic theory now, where you're starting to talk about when you start forecasting these future things, how do you make the best choices? And those are basically Bayesian statistical problems. And I think that this will be something that as we move forward with digitization, new tools, we'll start seeing some of those ideas migrate into what we do in operational quality performance.
Okay, I'm going to allow one more question because it was too good. So
okay, that means it's a nasty question. I understand. Okay, what is it?
Yeah. Absorption accounting tends to increase overhead when manufacturing improvements are made that tends to lead accountants to resist changes. Have you observed this, and what can be done to overcome this hurdle?
It's true. What happens with absorption is that when things are getting better, they actually bear more overhead. Okay, so it's absorbing more overhead because it's producing more efficiently. And actually, the only way you can get around that is to frequently reset standard costs. So it's the delay on setting standard costs or resetting standard costs where we actually go and figure out what is this really costing us. So if I really improve I'll give you an example. When I was at Hewlett-Packard, we had an obsolete product, and I was told it's the most profitable product in the company. And I took a look at it. We're only making 50 of them. And I'm just taking a look at this as an engineer, and I say, okay, it's PMOS technology. If I have to make this, I have to make 50 boards. PMOS technology no longer exists. So we have to redesign the board. Well, that's like an R&D product. And so we have to do this. And so we have to redesign the boards, then make them and so forth, test them, and get them ready to go. How can this be a more profitable product? Things are not adding up here. And what happened was that was a fully depreciated product. So on the accounting scheme, it looked on the books like it was really a profitable product. But in reality, it was stealing from everything else. And so the trend that this question is actually pointing up is pointing out a very true thing, that the worst products you have, they don't have all of their excess labor costs, that went into labor variance. They don't have their excess transportation costs, that went into transportation variance. The laboratories that they used up, that went into overheads for labs for, it's basically given as a flat charge to everybody. Maybe they have engineers who had to travel to different sites. That comes out of engineering overhead. So what happens is that doesn't all get charged back to that one product. That gets smeared across all products as a tax. And so your most profitable products look less profitable, and your least profitable products look more profitable than they actually are. And that's the problem with absorption accounting.
And the alternative is?
Activity-based costs and or rapidly change standard costs. Change it every quarter, and then your finance people will kill you for that.
Yeah, because that's the difficulty I've seen in companies that have standard costing. They trust it, and it gives them a yardstick for the future. And if you're changing it too often, then they well, it's a rubber yardstick now. How do I judge? Well,
it was a mud yardstick before.
Yes, cast in stone. Okay, well, this has been grand. Thank you all.